Welcome to the deep dive. Today, we're getting into a really interesting piece you shared. It's a report from February 2023 called "Could Investors Be Wrong in Front-Running the Fed's Coming Rate Cuts?"
Yeah, it's quite a mix, isn't it? Market analysis, some history, economic trends, and even, well, a perspective from inside Russia.
Exactly. So our goal here is to unpack the main arguments and see what really stands out for our listeners.
And it really kicks off by questioning that consensus view from early 23 that the Fed was about to pivot, about to start cutting rates.
Right, the whole front-running idea, the report basically asks, hang on, could everyone be wrong about this?
Precisely. It starts digging into historical patterns, specifically Tom McClellan's work on the presidential cycle.
Ah, yes, the idea that the third year of a presidential term is typically pretty good for stocks. Figure 1 in the report shows that pattern quite clearly.
But McClellan himself, even back in December 2022, was sounding a note of caution. He pointed out that the typical rally seemed to be, well, fizzling out.
And he linked that to the Fed.
Directly. He pointed to the Fed's really aggressive rate hikes and shrinking their balance sheet. You look at figure 2, the speed of that tightening compared to past cycles.
It was fast, really fast.
Yeah.
Unprecedented, the report calls it.
It definitely raises the question, do those old historical patterns even hold up when the Fed is moving that decisively?
And it wasn't just rates, as you said, but also the balance sheet runoff, the quantitative tightening. Figure 3 shows the Fed's assets coming down.
Yeah, they were reducing their holdings. But here's where the report takes a bit of a contrarian stance.
Okay.
It argues that despite all that, calling monetary conditions truly tight back then might have been, well, jumping the gun.
How so? Weren't rates going up sharply?
They were, but the argument hinges on real interest rates. You know, the rate minus inflation. Figure 4 makes this point.
Ah, so even with hikes, if inflation was high enough.
Exactly. Real rates could still be negative. The author suggests maybe official inflation numbers weren't even capturing the whole picture for many households.
Which means the actual cost of borrowing, adjusted for rising prices, wasn't really biting yet. Unlike, say, after the GFC when rates were low, but inflation was also much lower.
Right, so just seeing the Fed hike doesn't automatically mean money is tight in the way that really slows things down dramatically.
So the report has a specific definition of what actual tight conditions look like.
It does. It talks about needing to see things like massive bankruptcies, high-yield spreads really blowing out, definitely positive real rates, a very strong dollar, asset prices collapsing across the board.
And we weren't seeing all that in early 2023.
Well, the report points to counterexamples, like that crazy spike in Bed Bath & Beyond stock. Remember that? Figure 5 shows it.
Oh yeah, that was wild.
Huh.
Company clearly in trouble, yet the stock just explodes for a few days.
Exactly. That kind of massive short-term gain, especially in a distressed name, it doesn't really fit the picture of a generational market low, where money is truly scarce and risk aversion is extreme.
They mentioned high short interest playing a role there too,
Yeah.
right? Amplifying the move.
It does. So it suggests pockets of speculation, maybe froth, were still around. It wasn't uniformly tight conditions.
Okay, that makes sense. It paints a more nuanced picture. Then the report shifts focus a bit to inflation itself, specifically service inflation.
Yeah, this is interesting. Figure 6 shows how service inflation, housing, healthcare, that sort of thing, was actually trending down for decades, from the 80s to around 2010.
And then it picked up.
It started picking up after 2010, but the report argues central banks kind of ignored this shift, or at least didn't give it enough weight.
And the key point is that service inflation tends to be sticky.
Very sticky. It tends to persist. Once it gets going in one direction, it doesn't turn on a dime. That has big implications for how long the Fed might need to keep policy tight.
So this stickiness is a major factor.
Okay.
Following that, the analysis moves to the bond market. What were the signals there? Specifically, junk bond spreads versus treasuries.
Right. Looking at figures 7 and 8. The analysis shows that in early 2023, those spreads, the extra yield you get for taking on the risk of junk bonds,
Yeah.
they weren't anywhere near the levels seen in major crises like 08 or 09, or even the brief panic in March, April 2020.
They were more like average.
Pretty much around the long-term average. So the bond market wasn't screaming imminent disaster or signaling super tight conditions. It wasn't pricing in widespread defaults.
Which again challenges that narrative that the Fed had to cut rates soon because the economy was falling apart.
Exactly. It's another piece suggesting the market consensus might have been ahead of itself.
And the report distinguishes that March-April 2020 episode too. It wasn't Fed tightening that caused it, was it?
No, that was different. The report links it more to the collapse in commodity prices. Figure 9 shows that plunge. It was more of a sudden liquidity crunch triggered by a real economy shock.
And central banks jumped in hard then to prevent a bigger meltdown.
They did. It shows not all crises are driven by the same factors, and the response matters.
Okay, another indicator mentioned is volatility, the VIX index,
Yeah, the fear gauge. Figure 10 shows it was staying below 20 in early 2023.
which is relatively low, right? Suggesting not much fear.
Generally, yes. Below 20 often indicates a lack of major market stress or anticipation of really tight conditions. So, another signal not quite aligning with the imminent pivot narrative.
It's about building a picture from multiple indicators then.
Absolutely. And the report contrasts the 2020 crisis with typical recessions. Usually, recessions linked to Fed tightening happen when real rates are positive and the Fed is shrinking its balance sheet.
But 2020 was the opposite.
Right. Figure 11 shows real rates were negative, and Figure 12 shows the Fed was actually expanding its balance sheet then. It underscores how unique 2020 was.
So applying old recession playbooks might not work.
Yeah.
Then there's a comparison to the Fed's previous balance sheet unwind, the 2017-2019 period.
This is quite revealing. That earlier unwind, percentage-wise, was actually bigger, over 10% reduction compared to less than 5% by early 2023.
Okay, so a bigger reduction back then.
Yeah.
And market impact.
Interestingly, the report argues it didn't have a major negative impact on the S&P 500, figure 13, or Treasuries, figure 14, during that 2017-19 period.
But the smaller reduction in 2022-23 did seem to coincide with negative market moves.
That's the observation, despite being a smaller percentage unwind. Plus, figure 11 again, real interest rates were actually more positive back in 2017-19 than in early 2023.
Huh. So why would a smaller unwind cause more trouble this time? It suggests other factors were more important.
It certainly implies that. Maybe the starting point, the level of inflation, the overall economic context. It wasn't just about the size of the Fed's balance sheet alone.
Which leads into the policy dilemmas the Fed was facing. Doubts about whether they could, or even would, raise rates high enough to get real rates positive.
That's a core tension. To really beat down that sticky service inflation, figure 6, maybe the Fed funds rate needed to go to 6% or more, based on figure 4's real rate calculation.
But would they actually do that?
Yeah.
Given the potential damage to asset markets, especially the bond market?
The report expresses skepticism, a fear that such aggressive moves could cause too much disruption, particularly for Treasury bonds. That suggests a potential constraint on the Fed's inflation fight.
Meaning inflation might stick around longer than people hoped?
That's the implication. And political factors add another layer. The report mentions things like the big union pension bailout funded by the American Rescue Plan.
As an example of government spending adding to inflationary pressure.
Potentially, yes. Plus, the general vulnerability of pension funds if markets perform poorly, and the political difficulty of cutting government spending.
And rising rates make government debt more expensive to service, right?
Right.
Like in the 70s, figure 15 shows that historical comparison.
Exactly. And figure 16 highlights the massive surge in U.S. government debt since 2020, making that interest expense issue even more significant now.
So the Fed's kind of caught between high inflation, potential market damage, government debt costs, and political pressures. Tough spot.
A very tough spot, which opens the door to considering other potential outcomes. The report discusses the idea of bad deflation or bad disinflation.
Okay, what's that? Inflation coming down, but for the wrong reasons.
Essentially, yes. It's a scenario highlighted by Alpine Macro and the bank credit analyst, where inflation falls mainly because demand collapses, not because supply chains are magically fixed. Figure 17 touches on this.
So falling demand, that sounds like a recession.
It often is. This kind of bad disinflation could actually be good for bonds initially as rates fall, but bad for stocks because corporate profits would likely tank. Figure 19 makes this point.
And the report points to evidence of this falling demand.
It mentions the plunge in the New York ISM Manufacturing Index, figure 20, as one sign of demand destruction setting in early 2023.
So the market might have been front-running rate cuts, but maybe for a reason anticipating an economic slowdown.
That's one interpretation. The report notes equity markets seem to start pricing this in around October 2022. Figure 21 shows that rally, especially in beaten-down areas like European and emerging market stocks.
Yeah, figure 22 shows that huge outperformance of Hong Kong and China stocks relative to the S&P 500 starting late 2022. Partly the China reopening story too, I guess.
No doubt, the easing of COVID restrictions was a big factor there.
The Win Macau example, Figures 23 and 24 is interesting too. Stock pops massively, bond rallies too, but is maybe more stable looking back further.
It illustrates the different ways assets react. Equities capture more of that immediate sentiment shift, while bonds reflect broader rate expectations, maybe with a bit less volatility over the longer run.
So the report suggests maybe more near-term upside for bonds, treasuries especially, if that front-running scenario plays out, but longer term if inflation persists.
Then maybe equities are still a place to be over bonds in a longer inflationary upcycle. It lays out these different possibilities.
It also touches on a couple of more extreme tail risk scenarios, right?
It does, briefly. One is a really severe global GDP contraction. Think massive defaults. In that case, maybe treasuries are strong initially as a safe haven, but ultimately the report suggests holding precious metals, even collectibles, might be better if defaults become widespread.
Wow, okay. They even mention things like ice ages, figure 26, as examples of historical catastrophic triggers. Definitely outlier stuff.
Just illustrating the scope of potential risks. The other extreme is the opposite. The global economy avoids recession, maybe even accelerates, leading to sustained high inflation.
Pushing interest rates potentially even higher than the 1981 peaks, referencing figures 4 and 14 again.
That's the scenario, which would likely involve a lot more money printing, maybe even raising questions about U.S. debt sustainability.
And in that inflationary world, the author mentions energy investments. Shell, BP, Total, others listed in figure 28, and some royalty companies recommended by James Bullish.
Yes, positioning for potentially soaring commodity prices like oil in figure 27 and a rebound in indices like the CRB index, figure 9.
It also flags opportunities seen in Brazil and Argentina in late 2022, like the Merval Index, Telecom Argentina, Banco Macro, shown in figure 29.
Just highlighting specific areas that looked attractive at that time under certain views.
But cutting across all these scenarios, what's the view on currencies, specifically the US dollar?
The report is pretty consistent here. It doesn't see any of the identified scenarios as being particularly favorable for the long-term value of the dollar or other major paper currencies.
Suggesting continued depreciation over time and strengthen.
Precious metals, gold, silver, platinum. That's a recurring theme skepticism about fiat currency preservation.
Okay, now the report takes a really unique turn at the end with a section From Russia with Love.
Yeah, this is quite different. It's a first-hand account from Peter Hansler, a Swiss lawyer who's been living in Moscow for, over 25 years?
It's presented as a counterpoint to typical Western narratives.
Exactly. He shares his personal experiences starting from the late 90s, which he describes as quite difficult economically in Russia hyperinflation memories, the 98 crisis.
But he talks about the resilience of the people.
He does. And then he describes the transformation of Moscow over the last quarter century, the huge increase in restaurants, for example.
And interestingly, he notes the availability of goods even with the sanctions in early 2023.
Yeah, he observed supply chains adapting, routing things through places like Kazakhstan or Armenia. And he actually observed inflation decreasing in Russia at that time.
Which is a stark contrast to what was happening elsewhere.
It is. He also shares his views on media expressing skepticism about both Western and Russian sources, urging people to see things firsthand if possible.
And his perspective on the Russian relationship with the state.
He describes it as complex, generally skeptical, but acknowledging improvements in government services and noting the low tax burden. He talks about political freedom in the context of Russia's size and culture and its sort of general respect for Putin based on improved living standards compared to the 90s.
So it's a very different viewpoint. He calls Moscow a jewel.
It's definitely presented as a ground-level perspective intended to challenge assumptions built solely on external media reports.
Okay, so wrapping this deep dive up, we've walked through a report that, back in early 2023, really pushed back against the dominant idea that Fed rate cuts were just around the corner.
Yeah, it wove together historical patterns, then current indicators like inflation stickiness, bond spreads, the VIX, and argued that maybe conditions weren't as tight as the consensus believed.
And it highlighted the policy constraints, both economic and political, facing the Fed, plus those alternative scenarios like bad disinflation.
The core takeaway seems to be that front-running the Fed, assuming you know the next move based on the prevailing narrative, might have been, well, a risky strategy at that point. The picture was just much more complex.
Absolutely. The uncertainty was maybe the main message.
Right. Challenging assumptions, looking at a broader set of data, considering different potential paths.
So thinking about all that, here's maybe a final thought for our listeners. Given that possibility of bad disinflation we discussed, and the report's longer-term doubts about paper currencies, what does this whole analysis suggest to you about risk and opportunity today? Is following the crowd always the best bet, or, is it independent, maybe even contrarian thinking sometimes crucial for navigating what's ahead?
Something to definitely mull over.
Indeed. Thanks for joining us for this deep dive.